Hi guys! Today I'm thinking about how workplace pension income is taxed in various countries. In the UK, as in many other countries, we are compelled to save part of our income from employment into a workplace pension, with employers also making contributions, and we also have tax relief which aids in the pension growing over time. With consistently high contributions over the course of many years, a workplace pension can grow into a very large sum of money. And with the access age being 55, rising to 57 in 2028, many people who reach this age and have a large workplace pension pot find themselves debating if they can retire early or if they need to carry on working. But one thing that doesn't seem to be talked about a lot about the income from the workplace pension is that once you reach access age, if the income is run at a level which is over the personal tax threshold of £12,570 per year, it will be taxed by HMRC in the same way that any other income would. The following table shows a selection of countries and how they would tax an example amount of workplace pension income of £25,000 and how much money would be left over, both annually and also per month, after taxation and the cost of living being deducted in the host country. Also shown on the table is how the workplace pension income would be taxed by the UK itself for comparison. The UK has double tax treaties with all of the countries on the list, so no tax should be required by the UK tax authorities as long as they are informed of your new country of residence. The cost of living shown for the countries is for a single person per month. The amount of money left over after tax and the cost of living is deducted in some of these countries may surprise you. So just on the spreadsheet here, so the first column is the country. The second column is the type of income tax in the country and the rates. The third column is the amount left over from our £25,000 of workplace pension income after tax is deducted in the host country. The next column is the cost of living per month in dollars, and then we have cost of living per month in pounds, and then we have the remaining amount of money after the tax and then the cost of living is deducted for a whole year. So this figure here is the amount of money that we've got left in pounds per year, and then this is the amount of money that we have left per month. So the UK is shown for comparison purposes. So after deducting tax in the UK, we would be left with £22,514. The cost of living in the UK is £1,800 per month. So after deducting the tax and the cost of living for a whole year, we are left with £918 out of our £25,000, which is £76 per month. So in the USA, we're left with 23,700, which is 1,367 surplus and 114 per month. So in Italy, 18,600, 3,895 left, which is 325 per month. And in Spain, 18,700, 4,119 remaining per year, which is 343 per month. And in Canada, £22,500 left, which is 4,349 per year left, which is 362 per month. And in New Zealand, £21,200 left out of our 25,000, and after deducting the cost of living, it's 4,532 per year remaining, which is 378 per month. And in Portugal, £18,100 remaining after tax, which is 4,958 per year, or 413 per month. And in the UAE, we have £25,000 remaining, as there is no tax at all on the income. So after deducting the cost of living, we have 6,610 remaining in pound per year, which is 551 per month. And in France, £23,200, which gives us a surplus of 7,553 per year, which is 629 per month. And in Croatia, £20,700, which is a surplus of 8,153 per year, which is 679 per month. And in Cyprus, we have £23,900 remaining out of our £25,000, so the tax is £1,100 per year. So after deducting the cost of living, we have 8,609 per year, which is a surplus of 717 per month. And in Greece, we have £20,700 left and a surplus of 9,449 per year in pounds, which is 787 per month. And in Turkey, we have £18,200 after deducting the tax, which is a surplus of £10,306 per year, which is 859 per month. And in Mexico, we have £20,500, which is a surplus of £10,927 per year, which is 911 per month. In Uruguay, there is no tax on the amount, so we have our full £25,000, and after deducting the cost of living, we have £12,666 left, which is £1,055 surplus per month. And in Albania, we have £22,000 remaining, which is a surplus of £12,791 per year, which is 1,066 per month. And in Panama, there is no tax again on the amount, so we have our full £25,000, which is a surplus of 13,243 after deducting the cost of living, which is 1,104 per month surplus. And in Colombia, we have £21,200, a surplus of 1,3297 per year, and a surplus of 1,108 per month. In Bulgaria, we have £22,500 remaining from our 25,000, a surplus of 13,460 per year, a surplus of 1,122 per month. And in Thailand, we have £21,700, a surplus of 13,584 per year, which is a surplus of 1,132 per month. And in Brazil, we have £21,200, a surplus of 1,4354 per year, which is a surplus of 1,196 per month. And in Argentina, we have £23,000, a surplus of 1,5203 per year, or 1,267 per month. And in Chile, there's no tax on the amount, so we have our full amount. And after deducting the cost of living, we have a surplus of 1,5667 per year, which is 1,306 surplus per month. And in Ecuador, £23,800, a surplus of 16172 per year and 1348 per month. And in India, we are taxed to the tune of £3,800. So we have a surplus of 16426 per year, or 1369 per month. In Vietnam, we have £22,500, which means we have a surplus after deducting the cost of living of 16728 per year, which is 1394 per month. And in Peru, there's no tax on the amount, so we have our full £25,000 and a surplus of 17123 per year, which is 1427 per month. And in Indonesia, we have £22,500 from our 25,000, a surplus of 17394 or 1450 per month. And in Malaysia, we have a territorial tax system, so no tax on the amount, and after deducting the cost of living, which is £610 per month, we have a surplus of 17683 or 1474 per month. And in Bolivia, no tax again, so a surplus of 18553 and a surplus of 1546 per month. In Paraguay, no tax again, so a surplus of 18944 per year, which is a surplus of 1579 per month. And in the Philippines, no tax again on the amount, as we have a territorial tax system. So after deducting the cost of living, which is $616 per month, or 456 in pound, we have a huge surplus, and the winner on this table, of £19,530 per year, so a surplus of 1627 per month. So the outcome is that the country with the lowest amount left over is Australia, followed by the UK itself, then USA. So there is only one country where you would be worse off than the UK itself. There is a very broad range of income left over at the end of the month, starting from £14 per month in Australia, all the way up to having a huge amount of £1,627 per month left over in the Philippines, which is amazing when considering the starting amount is £25,000 divided by 12, which is £2,083 per month. There are 9 countries on the list where in theory you would pay no tax at all on the pension income, which are the Philippines, Paraguay, Bolivia, Malaysia, Peru, Chile, Panama, Uruguay and the UAE. Out of the remaining countries on the list, Cyprus has the lowest level of taxation, with £1,100 being deducted in tax and £23,800 being retained. The cost of living in Cyprus is $1,722 per month, or £1,274. So it's not the cheapest when compared to some of the countries on the list, but would have £717 remaining per month, and would certainly give you more money in your pocket than the UK, where you would have just £76 per month left over. So the sweet spot is to find a country with low or no tax, with a good standard of life and low cost of living. So if you are thinking of relocating within Europe, consideration may be given to Bulgaria, Albania, Turkey, Greece or Cyprus, being the 5 countries on the list which would give you the most money left over from your pension income. If Asia is more attractive to you, then you may want to consider the Philippines, Malaysia, Indonesia, Vietnam, or India. Or if you would prefer retirement in South America, some thought may be given to Paraguay, Bolivia, Peru, Ecuador, or Chile. Of course, if you are the kind of person who is attracted by zero tax destinations, you may want to go with the Philippines, Paraguay, Bolivia, Malaysia, Peru, Chile, Panama, Uruguay, or the UAE. Okay, guys, that was how workplace pension income is taxed in various countries. I'll see you in the next one.